SD Bullion has just launched Survival Food, headlined by the only 100% organic, GMO-free survival food. Prepare like the Doc. Purchase your survival food from SD Bullion today.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us today is a special guest returning, Ned Naylor-Leyland from Cheviot. And it's changed hands a little bit from Cheviot Asset Management when we had you here last, Ned. But great to have you back on the show and with us again.
Thank you very much. It's Quilter Cheviot now is the name of the business.
Why don't we start off right away, Ned? We know that you've been particularly interested in the ongoing investigations regarding precious metals manipulation, that investigation that's been going on in Germany. So we'd like to get your perspective on the investigation. And I guess I'm wondering, unlike the CFTC's multi-year, what was it, 3 or 4 times they investigated market manipulation in the silver market, is Germany's investigation likely to go anywhere, Ned?
Well, I think that the motivation is a bit different than with everyone else. I suppose if you look back at what happened when the gold window was closed or rather temporarily suspended under Nixon, you saw something vaguely similar in as much as the French, who had been participants in the London gold pool, sort of turned tail and suddenly started pushing against that system and asked for their debt to be redeemed by the Americans. So I think I see what's happening in Germany to be something of an echo to that, which is they realise that they're probably unlikely to get their full, I think it's 700 tons, back from the New York Fed based on the current run rate. And so I think the acceleration of BaFin's interest and investigation into the price discovery in precious metals markets, and they've said they're interested in the spot market, they want to look at the futures market, they want to look at the fix, they're basically interested in it all, relates to the speed of, or lack of it in repatriating the sovereign reserves. And so I think it's particularly interesting and a bit of an echo of that move by Charles de Gaulle and the French in the very early 1970s.
And when you speak of the rate of that repatriation, for our listeners who didn't see the story, I think out of the 700 tons that they're attempting to repatriate, they only got 37 tons back from the Federal Reserve in 2013. I don't think they got any from France. And what was really interesting to me and really confirming what many suspect was the fact that the Bundesbank received recast gold bars, not the actual physical bars that were on deposit with the Fed for all those years. They received freshly cast new gold bars. So what's your thoughts? What's your guys' thoughts on that?
Well, look, I mean, personally, I don't think the Germans would have been at all surprised by not receiving their own storage materials back. I mean, you've got to think about it the same way you would if you took a household of stuff and put it in storage for a few years and then called up your storage company and said, I'm coming next week to collect it. And they say, well, you can have 5% of it over the first year. You can have the other 95% over 7 years. And we reserve the right to substitute as much of it as we want for other stuff. I mean, it is a completely ridiculous situation, but I'm damn sure that the Germans are well aware of the true sort of status of the bullion market. It's not like they don't know, and I don't think on any measure would they have been expecting their original bars back, Doc. I think that's sort of a top line story. You know, they ought to get their original product back, but I don't think they would have been expecting it. It is, of course, amusing. I mean, seems to be a bit of conjecture as to whether it was melted back in Germany or in the US, but ultimately it makes no difference because at central bank level they know the original bars aren't available, and so whether they were melted and recast in the US or Germany is immaterial. Either way, it's a cover up of the fact that the original bars weren't available to them.
It's also worth pointing out, too, just from a historical point of view, Germany and the United States have always been very, very cozy when it comes to dealing with, in the 1970s in particular, counterbalancing the moves that France was making for calling gold from the New York Fed, and what ultimately caused the close of the gold window in the United States. Even in the early 60s, there are now declassified memos between the Bundesbank and the Chancellor and the Federal Reserve and the Treasury, speaking about how, well, we have to support the gold pool, back in the days of the London gold pool, and just if there were any nation around the world that would be more aware of the gold leasing and the problems that that would have caused by taking out all of the furniture of their house belongings that were on storage, it would be Germany. So they're playing with a full deck and understanding what the rules are. And getting back to what Ned was saying, too, about the whole run rate, if you figure 37 tons times roughly 7, I mean, that's not exact, but, for the sake of discussion, times 7 years of what they were speaking of, works out to 259 tons. And that, even with the generous 7-year period, Germany was probably looking at what's been going on in the time frame that has passed since they made their desires known, and they're just circling the wagons. They realize that this is not going to work.
Yeah, I mean, it's not going to work, and frankly, with the nature of what's gone on in the last 12 months, where clearly demand for both at central bank level, at retail level, is up. No one's really selling physical. You can see that if they can't do it now, when the market has fallen, or rather has, I mean, it's difficult even for me to say that the gold price has fallen, because while it has obviously, and clearly one's portfolios and one's investments on a dollar basis have fallen, along with that. When you see such complete divergence between people's interest and demand for the underlying versus the price on the screen, that suggests to me that if they've only got 37 tons now, I almost wonder whether they'll get any more. I mean, I hope for their sake they do, but to me, this looks almost like the last little trickle of the repatriation game, which is clearly kicked off by the Venezuelans. I mean, good for the Venezuelans, they managed to get those back. But, I've always looked at that London, or rather the Gordon Brown sale of the UK's reserves as potentially having been part of the same thing, because, I mean, not so many people are aware that the Germans did repatriate from London, or rather requested it just before that took place. And it's quite clear, with the benefit of hindsight, looking at the situation the way we know it is now, that of course that gold that the UK was custodying for the Germans was also likely to have been loaned, leased, swapped, etc., into the market many times over and unavailable for delivery. And that being the case, if it was unavailable for delivery, they had a choice of either buying the whole lot on the open market and sending the price way higher while doing it, or basically delivering their own to the Germans at that time.
Yeah, it should be said as well too that if when you price at the margin, as markets do, any attempt for Germany to repatriate tons and tons of gold in the neighborhood of 200, 300, 400, 500 tons or what have you on the open market would have sent gold over its old highs easily. There's another data point as well too that was interesting. Last month there were reports coming out of Swiss refineries that they were receiving 90% gold melt from the United States former gold hoard based on the previous coinage that we had, because our coins were 90% gold. So it kind of it's just one more piece of information that fits with this overall puzzle.
Yeah, and it also, when we talk about, Ponzi schemes, and we all know the way that the gold market works is a version thereof. That makes me remember back in the early 2000s being approached about pyramid schemes, pyramid selling schemes. I'm sure you guys know what they might have a slightly different name in the US, but where people come along and say, look, put $3,000 in and you get 40 grand out, and you look at them and say, you completely nuts. And then they go, no, it's fine. And then, of course, the way it all starts to go wrong is when people can't rustle up enough friends to add to it at the bottom. And that sounds very similar to what you're saying, which is when we get to the point where you're scrabbling around finding low-quality bullion to deliver, it's the same point at which too many participants have come in the bottom of the pyramid scheme and are unable to rustle up additional participants. And there's no way. There's also no way, guys, with the kind of breakup of the localized market that we see, that this can last for much longer. I know, it's easy for us to say that, and we've all been long and wrong for a while, but the truth is that with these kinds of premiums available in India, and that's a similar arbitrage opportunity that broke the London gold pool last time round. The same sort of 20%-ish arbitrage opportunities. I mean, people are talking about huge arbitrage opportunities into Argentina. What you can see is everything has got very localized. The physical is swirling around madly. I see a change taking place pretty soon, really.
And I just want to go back and touch on one point Ned made a moment or two ago in regards to the fact that Venezuela and Hugo Chavez was moved back in 2011 was what kicked the whole repatriation move off, and he's exactly right. And I've long thought that Hugo Chavez in Venezuela was really the trigger for the takedown of gold in late 2011, when it was more than the price breakout heading towards 2000, that the Western central bankers wanted to smash the sentiment of the metal and to try to get ahead of what would likely become a freight train of nations attempting to repatriate their gold in the manner that Venezuela did. So that's merely conjecture or speculation on my part, but it was only a couple of months after Venezuela's announcement that the gold market was taken down for the first time, and it really hasn't stopped since then. It's been about 2.5 years since.
And there also was a period of time where Germany was asking for audits and getting the rebuff from the Federal Reserve, so that corresponded a lot closer to Chavez's request in terms of a timeline of all of these events. So it's not a conspiracy theory to suggest that the Federal Reserve and the Treasury were well aware that there were nations who were getting incredibly nervous about allocated gold and gold that had been leased out.
Yeah, sure. And, I mean, I don't think Venezuela are a well-known participant at the Bank of International Settlements, guys. I think that what we can say is that there are, even the relationship between the Germans and the US, despite what's going on, will on some level still involve sensible discourse, which I think you could say wouldn't be the case with the Venezuelans. What they did, of course, was say, no, we want it back now, and if you don't produce it, we're going to cause a massive scene about this. So there was not much choice but to have that metal delivered, and I think you're entirely right to extrapolate and speculate that potentially that was the trigger, because, of course, if you were presiding over a big Ponzi and someone started to threaten pulling it down, you're going to do whatever it takes to get the thing back under control. So I think that does make sense, all speculative as it may be. It makes perfect sense.
Well, to have fun with speculation, maybe this had something to do with why the United States was bugging Angela Merkel's telephone. But I'll get more serious now.
And speaking of the physical demand, Ned, obviously massive demand is continued in 2013 in China. I think total Chinese gold demand for 2013 came in just under 2,200 tons, extrapolated from actual withdrawals from the Shanghai Gold Exchange. And even now, retail physical demand, we're seeing it in early 2014. The UK's Royal Mint ran out of its 2014 sovereign gold coins in, what was it, I think 5 days. And they had a pretty telling quote. The Mint director stated that the demand he said it was exceptional demand, and that the exceptional demand presently shows no sign of abating. So we're seeing it even in the West, retail physical demand. And the other story I wanted to share with you guys and our listeners hasn't made the news yet. Just yesterday, the United States Mint gave the 12 primary dealers or the authorized dealers for its Silver Eagle program. They're beginning allocation numbers here for January when their production resumes on Silver Eagles. And as most of our listeners are aware, the U.S. Mint had, like the Canadian Mint, had allocations the last couple of months of 2013 where the authorized dealers were only allowed to purchase a certain amount of Eagles per week. And when they gave their new 2014 numbers to the dealers this week, they were about a third of what their allocations had been towards the end of last year and what they were expecting. So one of the largest U.S. wholesalers and primary dealers authorized to purchase directly from the U.S. Mint, they've already sold through on pre-sale their first about 4 allocations from the Mint. So if you want to place a purchase today on the 10th of January, they're not shipping until the end of February because they've just already burned through their first 4 allocations because their weekly buy allotments are about a third of what they were expecting and what they were towards the end of last year, even though they already reduced allocations. So don't look for the U.S. Mint to sell another 7 million ounces of silver in January of 2014 like the numbers for January of 2013 because they simply aren't going to allow the dealers to purchase that many, demand or not. So I don't think you're going to see more than 1 to 2 million ounces of Silver Eagle sales for the month.
Which will of course be very bearish.
Well,
by the way, this is English sarcasm, yeah.
Right. And you'll see. I was just going to say you're going to see continued shifting to generic rounds and the other major mints, whether that be the Canadian Maple is really the next one people turn to, but then also the Austrian Philharmonic, the Mexican Libertad, and other things, as well as again, the generic rounds, bars, and so forth, which aren't reported at all, like by the mints.
Since you bring this up, have you heard anything recently updating the story that we first reported about a month ago with the Sunshine Mint having problems sourcing silver?
Yeah, they're still about 4 to 5 weeks out on, which is pretty amazing. And Ned, the Sunshine Mint is the private mint that sources the blanks for the Silver Eagle program. So the U.S. Mint doesn't produce their own blanks; they purchase the blanks from the Sunshine Mint, and it's one of the I think it's the largest mint in the U.S. And their own generic rounds and bars are about 4 to 5 weeks on delay, and typically they're immediate shipment. They're not a small mint at all. They're not a government institution, so they don't typically have like long delays like you can see with the U.S. Mint or Canadian Mint. Occasionally, some of the government-run mints.
I'll tell you one comment I would make about this is I think it sort of feeds into the data that we've seen in the last 24 hours in the broader market. Is that you're seeing things are getting really strung out. So there's a really strung out retail physical market. You're seeing clearly a bigger and bigger strung out arbitrage play. The backwardation of the front month is clearer and clearer. And then you look at the statistics that are being produced and how far out people are in what they're expecting. And you can see that you can drive a bus through the market and on every level at the moment. So whether it be something you guys probably didn't notice is this morning in the UK. I mean, I think we're all extra cynical about our own country's data. I mean, I certainly am about the UK. We came out with construction numbers today, and I don't know if you're aware, but the UK is driving the global economy now. In fact, we're doing so well that we're sort of the poster child for the inverted commas recovery, and it's all driven by reflating the housing market. And construction numbers came out today where we were expecting a 7.5% improvement year on year in construction, and it came in at 2.2%. And I mean, yeah, sure, sterling weakened by 0.1% or something against the dollar over the following 10 minutes, but it didn't even touch the sides. No one really noticed, and it was a miss by it was 29% of the expected number. And we're seeing this in the bullion market. We're seeing it in the macro numbers. It's just occurring everywhere, and it is certainly a sign that something's coming one way or the other.
Yeah, we're very proficient in manipulating our numbers in the United States, and I speculated earlier this morning with John that the non-farm payrolls release this morning, being such a negative surprise, is probably just cleaning up a little bit of the mess they created in the past couple of months of reportage, where they had clearly massaged the statistics in terms of seasonality measures and just, and all the various machinations that they do to make numbers look good. And this speaks to just pretty much the overall Anglo-American, in particular, economic backdrop. There's just a lot of deception and management of perspective economics, or perception economics, as Jim Sinclair likes to speak to it, that's going on, and painting the tape. The physical markets are now finally able to put a floor in the market, it looks like. I mean, our June 28th lows of last year are holding, and this week is interesting. We had a couple of big raids that were very noticeable, yet we're still reasonably positive in terms of bottom bouncing. So who knows, maybe we are scraping the barrel in terms of the cartel's ability to manipulate the markets further down, just because to push prices down further, you get those arbitrage spreads widening and pressure on physical inventories in the COMEX and the GLD and London bullion market. I mean, there's got to be a bottom sometime formed because of those constraints, and it looks like it's already been formed.
Yeah, well, I think it's fair point, Eric. And something else I would tell you, my experience working, in asset management, is that at the moment, funny enough, it's amazing how it changes just because it's the end of a year and the start of a new year. But there are a lot of people who've been very long equities, done very well. They're particularly pleased themselves. They consider things to be going, broadly in line with what the media are telling you. And yet, I'm talking to them and they're saying, I'm not sure. Yes, the market does look pretty toppy, and suddenly they've sort of got a bit more bearish on macro, and are starting to sort of question their positioning. And then they're saying, well, I think maybe I should be buying some gold at the moment. And then you remind them of the reasons why, and the value on offer, and all the signals that are there that are telling you that not only should you be in, but you should be well hedged on any level with precious metals. But they're not doing it. They're thinking about it, and they're talking about it, and they're looking, but they're not moving. And the reason for that is because the big money, the investment sort of pot that sloshes about out there. Number one, it's a smaller part of the actual price discovery mechanism than it used to be because of momentum trading and HFT and stuff. But the other thing is they're all just birds on a wire. They all move together.
Right.
And you've already seen today with, in my opinion, with the non-farm numbers, it's just short covering. It's not. No one's buying gold today, outside of retail and the odd informed individual. Really, what you're seeing is a little bit of short covering, and we're certainly not seeing a catalyst, because when we do, you will see the market. It will start doing the 4 or 5% a day. That's when people start buying, as opposed to there being marginal short covering activity. You're going to see much bigger moves than a paltry 1.2% on a simply dismal employment figure.
Yeah, I totally agree. Looking at the price action, it's kind of interesting. I'm just going to throw this out as a quick footnote for people to watch. We are recording this actually much earlier than we normally do for our listening audience. So we normally record after the market close on Fridays, and we're only just a couple hours in the normal trading. But as you can see from the action in the price of gold and silver with the COMEX trading, we did have that price spike up with short covering. Gold is actually moving up after it had settled back down like a 1/3 roughly for retracement, whereas silver is going down. So that's kind of interesting. It seems that it may not necessarily be pure short covering in the gold market, in that there may be some organic buying stepping in just because it's picking up again. But that's neither here nor there. I just wanted to throw that out. With your experience over the last many years, having your ear to the institutional client base that you guys serve. I'm curious if you can tell a shift that is going on with people's awareness, the general equity investor, the pension fund, the average person who's just paying attention to the markets as a punter or what have you. Do you sense that there's a shift going on when people understand the difference between paper gold versus gold in hand or gold in allocated storage? How much of that awareness do you think has been taking place over the last couple of years? Because that's going to be a really important factor in basically breaking the so-called price mechanism of the paper markets that obviously is being manipulated. What's your insight on that?
Excellent question. I think that the average client is no more aware. I think that they would just be, and probably are, baffled by the difference between supply, demand, and price action. I think that that's something which really is more for the sophisticated investor. So that feeds into the question of, well, what about the guys that I work with and talk to? Well, I think that, yes, they do probably understand the issue better. I think the fact that things like the Financial Times brought this up relatively recently. They made a comment about a potential disorderly move when inventories need restocking. But I don't think that it's meaningful really in terms of price action at the moment. I think, yes, they are more aware of it. I think that once they start to see $50, $60, $70 moves in a day, then the interest will be there to understand it more. And what I mean by that is yes, I think at the margin people have heard that story a bit, Eric. They've heard that there's this issue, but are they really paying attention, and do they really care? No,
right.
Not really. As far as they're concerned, it's the trading mentality. Either something's going up or it's going down. If this is going down, why are you even paying attention to it? You must be mad. It's just a whole different mindset. It's just a whole different mindset, which is based on the underlying conviction that things are okay versus the underlying conviction that things are absolutely not okay at the moment and are likely to get substantially worse over a very short time frame, which would be the view that the three of us would have, and I believe is based in even in the manipulated data as well. It's blindingly obvious. But the reality is that people don't. It's this difference between trading mentality and the big picture monetary view. People don't want to think about 2 to 5 year investing. They don't want to think about loss of purchasing power, particularly when the government is telling them there's no inflation. So your institutional investor, will tell you that there's there's no negative real rates, and that actually, the equity market tells you everything you need to know, which is that things are going really well. I mean, in that way, you'd have to congratulate the central planners for doing a pretty good job of moving the sheep around as they would want to, because although there are some young people in the market that I talk to who are institutional, who are sort of starting to get it, I think, over the last 2 years, I could say to you, yes, the younger brigade are more aware of these things. But the people who have benefited from the situation that we've had for a long time are no more interested than they were at any point over the last 10 years.
All right, well, I know that, Ned, you've got a train to catch, so we'll wrap up the show this week here. But before we let you go, tell our listeners a little bit more about Quilter Cheviot, which is, again, changed from previous the Cheviot Asset Management.
Sure, it's just a bigger version of we merged with a slightly larger asset management company in London, and we offer private client services. I'm the outlier, being a gold bug and being interested in the sector. But yeah, we're a London-based firm. So anybody who wants to know any more about it, you can find us online.
All right. Well, it's great to have you back. It's been quite a while, Ned, so appreciate your time, and always great to get your perspective on gold, silver, and the markets.
No, fantastic, and then let's do it again in due course.
We'll do that. So for Doc Eric Dubin and special guest host Ned Naylor-Leyland, thanks for tuning in to the SD Weekly Metals and Markets.
SD Bullion.